Hello, everyone. Please come on in. Come join. Shout out where you are calling in from today, please. I would love to see where the audience is calling in from. I'm in Chicago, New Haven, Charlotte. Very nice. Who else we got? Indianapolis, Paris, Sydney, Fort Wayne, Salt Lake City. You got people all over, Blake.
Yeah, I love it.
We're gonna get going in 1 second here. I'm calling
Columbia,
it an audible.
Bogota.
Bogota, nice. You guys have a portfolio company in Colombia, or am I making that up? Somewhere in
We
South America.
we don't. Yeah, we have some. There is a portfolio company with employees in Colombia and customers in Colombia.
Awesome. Well, come on in, everyone. Oh, BC, Canada, very nice. We'll get started in a minute as everyone joins. One thing I did want to highlight is that this year, for the first time, in addition to the report together that we've put together with High Alpha, we partnered with their team and our team to build this beautiful benchmarks report. If you go to benchmarks.visible.vc, you can go and check it out. I'll go ahead and share the link right now. It's going to prompt you to put in some of your inputs. Let me send this to all. But it's really great. So when you scroll down, it'll kind of give you a narrative of where you are within the report and just some kind of call outs of where you are against the median, uh, the top growth rates. So you can go and check it out. Something we're super proud of and new this year, and I think you can expect to see this in future years. And feel free to put some dummy data in and start over if you want. We don't do anything with the data, but yeah, go ahead and check it out.
Yeah, it was fun to work on that with you guys, Mike. The It was a great collaboration between High Alpha and Visible, and the design team here at High Alpha made it look beautiful, and you guys did a terrific job of the all the coding behind the scenes stuff. So
I wish I could take credit. The credit goes to Chris and Mitch and Matt on our team. So I will pass that along. All right, let's get into the benchmarks. Blake, can you see my screen?
yes.
Awesome. Thanks, everyone. We are recording this and we will send a recap out. Our goal here is to spend the next 30 to 35 minutes walking you through some of the content as it relates to really kind of geared towards founders first and foremost for today's session. And really the benchmarks investors are thinking about and most top of mind coming into 2026. And let me go ahead and move on. So, my name is Mike Pruce. I'm the founder of Visible. For those of you that do not know Mike or me or Visible, we build products for founders and investors. So, on the founder side, we help founders update, raise, and track the key metrics across their portfolio with their investors. And then we have a whole solution for investors that does the inverse, kind of understanding the portfolio health in general fund management for investors. And we've been part of the SaaS benchmark survey since I want to say 2017. So it's past 8 years or so when we started this with OpenView. And I would love to introduce Blake. Blake, would love you to introduce yourself, a little bit about the survey, and we'll jump on in.
Yeah, sounds great. Thanks, Mike. Really happy to be here and love talking about this survey. It has been the last few months of my life just crunching numbers. And believe it or not, I actually enjoy doing that. So, looking forward to sharing some of our findings with everyone here today. So, as Mike said, I'm Blake, partner and CFO at High Alpha. High Alpha is a B2B software venture firm based in Indianapolis, Indiana. We've been at this venture thing for about the last 10 and a half years, and we're investing out of our fourth fund, which is a $125 million fund, and we lead seed and Series A stage investments. We also do a little bit of co-investing alongside trusted partners in the venture community. And then we have a studio motion as well, where we work with founders at the very earliest stages to help them go faster as they begin to build their business. So that's a little bit about High Alpha. Quick background on me. I've been in the SaaS finance world for the better part of 2 decades, which is kind of staggering to say, but and I've been looking at, as Mike mentioned, this report it has been coming out every 9 years. And prior to High Alpha taking it over 2 years ago, I would eagerly uh, download the report and go and compare all of uh, my portfolio companies' data to what we were seeing in the report. So I've always been eager to to check this out. So hopefully the same for all of you.
How many respondents this year? Like, is that something you're publicly sharing?
Yeah, absolutely, Mike. Thanks for asking. So we had over 800 respondents from all over the globe. The majority of them were US based. We had a very nice range of different size companies from less than 1 million in ARR up to well over 50 million in ARR. And a nice mix of companies, ICPs as well, where they're selling to enterprise, mid-market, SMBs. So we really got a nice wide spectrum of respondents. And then finally, one thing we're always really proud of is half of the respondents were CEOs or founders. So really great to get CEO and founder perspectives answering these questions.
Yes. And if you did respond this year or previous years, thank you, because without you, the report does not happen. So shout out to anyone that helped us build the report this year. Um, there's a lot of ways to get the report. You can scan this QR code right here. It'll take you to the reports. It's on the website. It'll be in our recap. Hopefully you already had a chance to view the report, but if you haven't, plenty of ways to get it. I'll hang on here for one more second in case you are scanning that QR code, and then we'll kick things off. I'm gonna start this quote from Kyle because I think when I think about benchmarks, like how do I use benchmarks? How do I think about benchmarks? And when we talked to Kyle, who was previously at OpenView and now at Growth Unhinged, he talks about them being like a diagnostic and not an actual like playbook of like here's what you need to do. And I think it's really helpful to think about like the quote here. Like I wouldn't look at them on a weekly or daily, but probably quarterly or at max monthly. I think it's always helpful. Like, okay, great. We have all this really interesting, compelling data. How do I go and apply this to my business? Like to kick us off, like at a high level, how do you think about benchmarks from a sourcing perspective of potential investments you might make at High Alpha? And then how do you think about applying them to companies that are already in your portfolio or companies you've started as like a diagnostic? And then maybe like the third part of that question is there a difference between the two? Like how you would apply them to a current portfolio company versus a potential investment?
Yeah, so first of all, how do we use this from a screening perspective? It just gives us a very, I'd say, timely perspective on what's happening with companies that are in the stages that we're looking at investing in. So we absolutely do think about the data here, whether it's a company where they fall in the median versus the top quartile across a number of these different metrics. And we'll look at a couple slides that are particularly useful for that, both on our side as investors, but I think also on the operator side as they get ready to go out and raise capital. So that was kind of part one of your question, Mike. Part two is how do we think about that in terms of our own portfolio? When we're sitting in board meetings, when we're helping companies think through their 2026 plans, like now especially is a particularly helpful time to look at this data as you get ready to plan 2026 or as you're in the midst of that. And then also reflecting back on 2025. How did things go? Where did you fall short? What were some of the strengths of the business as far as metrics go? So yeah, so it helps us provide better advice and input as we work with companies to look ahead and where they want to go. And then as far as how we compare and contrast, I wouldn't say there's a big difference. As Kyle mentioned in his quote here, it's just a great diagnostic just to understand where you compare to your peers, and then also as a roadmap to see where you might want to go as a business. So say you're in the $1 to $5 million ARR band. But obviously you aspire to be in the 5 to 20 million, 20 to 50, and so on. You can see what that looks like based on current data and help inform your business strategy to get there and be a top performer in those ARR ranges.
Put you
Mike,
on the spot.
can I ask you? I'm going to put you on the spot.
Okay,
How do you at Visible use this data?
that's a great question. I I use it a lot in monthly, but especially like quarterly all hands. Like as I always share our board deck with the entire team 1 week after the board meeting. So here's the content we did for the board. Here are the outcomes from the board meeting. And then I usually pair that, whether they're in the board slides or not, I will use that to compare um, where we are with our peers. I'm usually doing that by ARR band for the most part. So, the ARR band we fall in, and I'm using it like, hey, we're doing great here. Let's keep going. And every once in a while, I think it's like, okay, where is there a gap, or maybe we're not in the median, and then is there a is there a counter lever to that, right? I'm trying to think of one off the top of my head. So like year-over-year growth rate versus burn. Those two things kind of work in hope probably in opposite, right? The higher the growth rate, probably the higher the burn. Um, but let's say something we want to improve, we'll kind of put that into our strategic planning. So net dollar retention, for example. All right, where are all the things that go into net dollar retention that we can really focus on and see if we can move that benchmark. So I use them with our team on a quarterly basis as part of the reporting we do to the board, and then that informs our strategic planning. How's that sound?
I love it. That's great. Exactly
My
how
question for
it
you
goes
is, you
about
mentioned
now.
2026, which is something that's on, I think, on a lot of minds.
Yeah.
You have to pick one metric. Like, is there anything that's like hot in the streets right now that wasn't in the past? Like some years it's like Rule 40, if you're like a couple of years ago, right? Like how healthy is the growth, or plus, it's like, is there anything that's like captured more mind share recently than in years past?
Yeah, I'd say one metric that is in that zone right now that I've heard about more in the last 6 months than I did in the prior, 6 years is gross revenue retention. So you mentioned earlier net revenue retention, super important metric. Companies should definitely pay attention to that, definitely try to optimize it. But obviously, one of the most important or the most important component to net revenue retention is gross revenue retention. And so, particularly in scenarios where a potential M&A is involved, or kind of growth rounds, investors are looking at or acquirers are looking at a company's level of product market fit. If your tool is valuable and your customers love the product and they don't want to see it go away, you're naturally going to have higher gross revenue retention. And so that's kind of the hot metric I've seen recently.
Is that primarily because of the rise of a lot of the AI solutions out there where you might try it once or a few times and then churn off of it? And is that why gross revenues because hotter than it was in the past?
I don't, yeah, Mike, it's a good question. I don't think so. I don't know this for sure, but the AI, the AI thing it will be fascinating to see over the next 12 to 24 months what retention looks like for many of the businesses that have been born over the last couple of years and are just beginning to hit their first renewal cycles. So I think that'll show up for a lot of AI companies, but I think fundamentally, even non-AI companies, I mean, the strength of the business is pretty directly correlated to your ability to retain your customers and retain their dollars. So I think it's both.
Yeah, we got some good slides coming up with that as well. So a lot of today talking about the state of fundraising. So we'll jump in there and get things kicked off with the actual data. Uh, Blake, I'll let you kind of kick things off here. I got a question for you, but I'll let you kick things off on kind of deal activity, so,
Yeah.
for this year, and then we'll kind of get into some Q&A. Oh, and by the way, if you have questions, please write on in. We'll either answer them now, or I'll pocket them to the end of the session.
Yeah, perfect. Thanks, Mike. So on From a macro perspective, VC activity, you can see the headline here. Deal value returns to 2021 levels. That's the green bar in the chart you're looking at versus deal count, which is the line. Um, Deal value has surged the last 4 quarters, and not surprisingly, that is largely driven by AI, and in particular, some of these mega AI deals that we've been seeing. So, while deal count has remained pretty flat, the value has gone up significantly over the last 4 quarters.
What does that mean for a lot of the audience here is earlier, call it earlier stage? What does that mean for like early stage companies? Like, is the bar higher? Am I raising a larger round early on? How does this impact me as a founder? Call it that's like a pre-seed to Series A type founder.
Yeah, Mike, I don't think it's a tremendous impact to founders. Like if you build a good business with solid metrics, then you're going to be fundable, regardless of the environment. Certainly easier now because there's a lot of capital out there and available. Maybe one thing that I'll point out that's in the larger report, if you all download it and get a chance to take a look, is we asked the question about companies that are AI native or where AI is core to their product versus companies where AI is merely a supporting feature. And across every single ARR band, companies where AI was core to the product were growing faster. So I think that gives the nod in terms of fundability to those companies where AI is core to the product. That's not to say that there are no fast-growing companies where AI is a supporting feature, but it's certainly based on that data and those numbers would kind of encourage you if you're very early stage right now, just thinking about how deeply you can build AI into your product. And I know that sounds relatively obvious, but it was a kind of a surprising insight when we pulled apart the data.
Speaking of AI, that's a good transition to the next slide here, which kind of breaks this out by AI deal value versus total deal value, kind of exactly what you just said, Blake, of the lion's share going to AI companies. Can you speak like to the average deal size now exceeding 40 million? That's interesting to me.
Yeah, so if you do the math on the prior slide, it was kind of 20 million was more kind of historical. 40 million deal size is significant, and it's really pulled up by these massive rounds. I mean, there was the OpenAI $40 billion round. Databricks has done some, 10, $15 billion rounds. So those just single massive rounds just pull up that average so much. So I think it's a little bit misleading in that regard, but there are certainly many companies out there that are just growing like we've never seen before in software, at a pace or rate that we've never seen before, that are commanding these massive rounds. And so that is certainly an aspect of it. But just because you're not growing, you're not the 0.1% growing at that pace, does not mean that you won't be able to raise capital.
Okay. I think I answered my question around um, what's happening here. Is this going to reset investor expectations like for early stage rounds, or is this more late stage that's really influencing the data here?
Yeah, I don't think it resets expectations necessarily. As I mentioned a second ago, I think there are these like just extreme outliers for growth, and those are their own unique and different thing from an investment perspective. Many companies are growing at like historically normal rates, growing quickly, but not at whatever 10,000% year over year, like you're seeing with the Harveys and Replets and Lovables of the world. So no, I don't think so. I mean, I think we'll get into the details here in terms of metrics, but if you build a solid business that kind of hits the mark on revenue growth, on net revenue retention, on Rule of 40, then you're gonna be able to likely raise capital.
All right. Uh, I thought this was interesting too. So this is the timing of the most recent round. This is for the respondents to the survey. Is that correct? This is
That's
not
right.
macro data. Okay. Um, and so Series C companies, and later have not raised in 2+ years. Like any hunches why that's happening? Is that maybe these companies are not AI native? Does that have to do with liquidity? Like what's happening with like the skew you see here of like Series C company not raising in the last 2 years?
Yeah, it's pretty significant and noticeable when you look at the chart. My hunch, Mike, is that it is related to those companies, call it 3, 4 years ago, 2021, early 2022, were able to raise a bunch of capital because they were growing quickly and it was a growth at all costs environment. And then the market swung to prioritize efficiency in a significant way in later in 22, 23, and into 24. And so I think that those companies adapted to that. They got lean, they got efficient, and there are some slides in the broader deck that show some of those later stage companies and the decrease in headcount in those companies was just really striking. And so they've got to break even or cash flow positive. And so they've controlled their own destiny. They don't need to raise capital. And so, that just gives them a lot more optionality. They can go longer without raising. And if you don't need to dilute yourself, then don't do it.
Are they growing as fast though?
Not as fast as they were back in 2020 and 2021,
Yeah.
but I would argue that they're much healthier businesses now. So it'll be really interesting to see over the next couple of years what happens to them in terms of like exits and
Hmm.
whether that's something that acquirers find attractive. But I think these break-even businesses they're gonna find a home in through private equity roll-ups or strategic acquirers that don't want to buy a business that's burning cash, but they will buy a business that has material ARR and is break-even and additive to their product portfolio.
Okay. Speaking of kind of fundraising, this is an interesting slide around fundraising success, remaining strong. My favorite part here is, by the way, uh, someone spent more than meeting with 100 investors, but the people that spent with more than 100 investors actually raised capital. Like I love that. That's just like a great
Yeah.
story and a testament to grit. Um, anything else we should be thinking about, like in terms of fundraising success? Because like I think at least for me, when I'm online, I'm reading online, it's like it seems like everyone's saying the bar is higher. This is saying that the success remains strong. I guess, and how do I map those two things? And then on top of that, is there any bias with like the survey respondents? Like, am I more likely to respond to the survey if I've raised capital successfully?
Yeah, I wouldn't say you're necessarily more likely to respond to the survey if you've raised successfully or not. You might be more likely to say that I tried to raise if you raised successfully, versus those that were maybe having more kind of casual conversations, not really raising per se. So yeah, I think it seems a little bit paradoxical that the fundraising market is being talked about as being kind of a little bit different and more difficult to raise in some corners. Uh, I would say that those who knew that they weren't likely to be able to successfully raise probably just hunkered down and tried to extend their runway and they didn't try. And so
Hmm.
therefore, I think of the 40% who did try, that's why there was a pretty good success rate because they must have had fairly strong, either they had fairly strong businesses that were able to find additional capital, or they were the 6% that talked to more than 100 investors.
Okay. Anything else you wanted to add here? We're going to switch over to metrics and signals that investors prioritize. But anything on the fundraising side you wanted to wrap with?
No, I just maybe add quickly, Mike, that yeah, I mean, 75% were either oversubscribed or raised their target. That number was certainly higher than we expected to see. So that is encouraging.
Hmm. Yep. Yeah, that's awesome. All right. Moving on. Uh, this is getting into some of the metrics I love. We talked about gross revenue retention being kind of the having its it moment heading into the new year. But here's a breakdown where good is the median, great is the upper quartile, and just to kick things off here, Blake, like how do you recommend founders use these benchmarks? Are they best used to help validate like when to raise? Um, does it help me identify like what I might need to have some story or narrative around if my marks are not the at the great level? Like how should I use this as a founder in my toolkit?
Yeah, absolutely, Mike. I think both of the things you mentioned and more are a good use of this scorecard. So, first of all, just understanding where you fall relative to your peers is, I think, super important, of course. And so, if you are below good on many of these metrics, then I think that tells you not time to raise capital. We've got some things to sort out before we should go out to market, unless there's a really good story of why that's the case. And then once you do go out to market, it's unlikely that most of these companies or many companies will be in the top quartile across all these different metrics. And so then you just have to think about what's your messaging that you're taking out to the market on why you are particularly strong on gross revenue retention, for instance, but not as high on net revenue retention, and how you plan to use the capital in order to make adjustments there and get to top quartile in that, in that particular area. So I think it's a good, just a good guide for founders in having strategic conversations with either their current investors, if they have current investors, or amongst themselves and their teams, to really map out what their strategy is.
We got a great question that just came in. Do you typically look at these metrics across a 12-month period?
Yes. I mean, the short answer is yes. So specifically on gross revenue retention, net revenue retention, those are annual numbers. So how much revenue of your base 12 months prior did you retain in the most recent quarter? So yes, that'd be the short answer, but these numbers are applicable on a trailing 12-month period. So anytime you want to look at them throughout the course of the year, they should be relevant, and then they get refreshed each subsequent year.
Good question. Is ARR annual recurring revenue or annualized recurring revenue?
That is a good question. And I think that people define those two things very similarly. I think that in true ARR, it is annual recurring revenue. Historically, in SaaS businesses where you had annual contracts, I think that as we've shifted to more of an AI world, and there's more and there's a lot of info on pricing in the broader survey or broader report as well about how people are pricing their product with utilization or usage, that has morphed into more of the latter, the annualized recurring revenue. So taking the most recent period and annualizing that. My guideline for founders and investors is if you have strong repeatability in something, even if it's not an annual contract, but you have enough data over time to have a high degree of confidence that that revenue is going to repeat, then I'm comfortable seeing that as ARR for a SaaS business or an AI business.
Yeah. One other question we had. There's a big jump in great expectations between 5 and 20 million in ARR per employee. Let's see where we're at here. 5 and 20 are in, let me find the question again. Sorry. How should founders think about this? And the expectation shift, is it gradual or do you like expect some sort of like inflection?
Yeah, it's gradual. I mean, you would be hard pressed to kind of make that flip from, if you look at the great on 5 to 20 and then great 20 to 50, to go from 220 to 350. That would require you to cut like almost half your team to make that transition. So it's something to map towards over time. And 20 to 50 million ARR is a fairly sizable range, as is 5 to 20. So you can kind of plot the continuum as to where you are on that range, with that 220 maybe being at the midpoint. If you're really looking to get a little more granular, that's not perfect, but at least directionally would show you, are you like ahead or behind pace of where you need to be in order to get from what's great in the 5 to 20 ARR band versus what's great in the 20 to 50 ARR
Hmm.
band.
All right. If you have any other questions, please write in. Oh, here we
There's
go. We get
Mike,
another one from Luis.
there's a
Oh, go
question
ahead.
from yeah. Which of these ARR ranges is great for Series A? We didn't break it down by financing round, but typically in SaaS businesses, you see the Series A raised in that $1 to $5 million ARR range. So you're either approaching a million in ARR, or just over, 1, 2, 3 million. So I would look in that range. So there's a big delta between the less than a million and the 1 to 5 in terms of great year-over-year growth rate. What we typically see is something what's I would call great is something in between that in Series A when it's like 1, 2, 3 million in ARR growing at call it 200% plus year over year.
Great. We got another question coming in. This one's from the Q&A feature. Would you consider applying any discount to any of these metrics for a less than $1 million ARR B2B SaaS company that is in a frontier market versus emerging?
Hmm, it's a very good question. Um, I'd say the one thing that I would discount for, let me talk about AI really quickly. What the one thing I would discount in terms of AI, relative to what we see here is the software gross margin. I think we're just seeing lower gross margins in that world because you have to pay the model providers and there are just kind of higher costs to serve the customers. The counterbalance, of course, is that those markets are potentially much bigger. And so you end up with a business that, while it may have a lower gross margin, the actual gross margin dollars that fall to to that bottom line are much greater. I don't know if that answers the question, but that's a kind of a quick take.
Yeah, I liked it. I liked it. The next two slides are fascinating to me. So this one's really interesting, which is like the consistency as it relates to year-over-year growth. I think it's just like fascinating, kind of like a law of numbers, especially with like some of these like earlier stage bands, Blake.
Yeah.
Um, yeah, I just curious, like, kind of what's this is like a law of numbers, just like this is just what happens. Like, what's going on here?
Yeah, it's a great question, Mike, and honestly, I'm not totally sure. It was really interesting to see these numbers and look at that less than a million ARR band and just see how tight it's been over the past 5 years. It just tells you that businesses at less than a million in ARR, the median grows at a pretty predictable rate. More, a little bit different than that. You look at what we were referencing earlier back in the 2021, 2022 times, growth at all costs, and all the larger businesses in a million ARR are down pretty substantially from those growth rates, but I think the important part is they've kind of stabilized. And so our takeaway was this is maybe more a durable growth rates than what was experienced a few years ago in a very different market we were in.
Yeah, the fascinating part is when you look at this now and you go to the next slide, this is median growth rates. Here's the upper quartile. Again, some consistency across the later bands, but earlier stage, it's actually accelerating from 2023. Is that driven by like AI native companies now, or what's driving this acceleration at the top quartile?
Yeah, that's my take, Mike, is that we have entered the world of AI experimentation. Everybody's got AI budget, and so a lot of these less than $1 million ARR businesses were started within the last couple of years. They're AI native, AI is core to their product, and they are taking advantage of the fact that businesses are wanting to experiment and invest in those types of tools. And then this goes back to what we were talking about earlier, though, with retention rates. Are those going to stay strong, or are those going to plummet once companies have tried out a few different tools and
Hmm.
kind of decided we're spending too much overall on AI, but these are the couple tools that we can't live without moving forward.
Yeah, it's fascinating. Uh, Now, talked about growth. We talked about upper or quartile growth, and kind of at the intersection of that now is like how efficient is that growth? And this, I think we all can kind of read and digest the slide here or after. But like, not every company starts with like a low CAC or high net revenue retention. These things evolve. So like for early stage founders, what are like early signs or patterns that point to like maybe future strength in these areas that maybe not will not show up in like a stellar metric today?
Yeah, so I'd say first on CAC, earlier stage companies CAC tends to be much lower because the founders are doing the selling. There's maybe a little bit more word of mouth because it's subscale, and so every incremental customer that's added is a little bit easier to get because it's through referrals and there's not a lot of marketing brand recognition. So I think that low CAC early on, don't get fooled by that. I think you have to figure out how to build a sustainable engine that continues to bring in new customers. On the NRR side, I think this is an area where there's a lot of potential for early stage companies to really plot out how they're going to grow into a really healthy net revenue retention zone. And so, companies, they aren't multi-product yet. Those early ones, they're single product. It's kind of hard to generate high NRR. You're certainly seeing more now with a little bit more variable pricing where if customers are getting value from the product, they're paying more through that variable mechanism. But I would just encourage founders and investors who are advising founders to be really thoughtful and strategic about what that roadmap looks like to improve net revenue retention. It could be things as simple as more annual agreements, as building in price escalators in multi-year agreements, or then just keeping a very, very keen eye on utilization and finding ways to monetize that additional utilization that you're getting from your customers.
Are there any decisions that you would make as it relates to net revenue retention that could impact gross revenue retention in a negative way? I'm just spitballing here, right? Because we talked about how gross revenue retention is like the it metric. Uh,
Yeah.
I'm just trying to
I,
go. I
I
don't
don't know,
think
Mike. I
so.
don't know, Mike. My first reaction is like a pricing model that's too complex to where you just kind of make it complicated for the customer to buy. But it's a good question. I'm not sure I have a great
Yeah,
answer. We're gonna have to
yeah,
come back to that one.
yeah. Okay. There are some questions coming in, so we will get to those towards the end. We got a few more slides here as we shift from metrics to relationships, and we'll land the plane with some final Q&A. This quote comes from Jonah. We had Jonah on our podcast here at Visible earlier this year. We talked about in person just being a big importance, right? There's a huge amount of things that are going to be done by AI. But at the end of the day, like all of us here, probably on this webinar and in live stream, are in the venture space, and these decisions are made by people. At least as of today, these decisions are made by people in terms of do I start a business, how I fund the business, um, and I think it's really important to think about relationships as we evolve, with AI being on everyone's mind, and it's kind of going to show itself here in a few slides, but. Uh, this was interesting to me. Direct sales is still the most prevalent go-to-market channel. Can you unpack the slide for us and walk us through why direct sales is still the most prevalent channel, Blake?
Yeah, I think part of it, Mike, is a function of the B2B SaaS history. Like, what has worked in B2B SaaS in terms of selling, and traditional direct sales works. I was thinking about this a little bit as I was prepping for this webinar today, and I think that there's gotten to be so much noise with automation, and I think that authenticity and figuring out how to make a personal connection really helps and works. So it wasn't surprising for me to see traditional direct sales as the number one thing on this list. I think it's really hard to build a good self-service motion, for instance. So yeah, I mean, it's kind of funny. What's old is new again, and I think as the title of this section read, relationships matter.
Yeah, yes, they do. We have made even just anecdotally, like over the last 9 months, and one of our values heading into next year is like in person on purpose, because we've had so much success just meeting with current customers in person, potential customers in person, and it really just kind of changes the dynamic of the relationship versus like just chatting with a chat bot that doesn't work all that well. And then this is just again, I love thinking about channel and channel mix and I also thought this was really interesting around like events. I mean, across all ARR bands, are highly important as a way of um, driving channel and demand gen. Um, like I feel like product-led growth is was kind of like in the conversation, still in the conversation, especially with like some of the vibe coding tools. But like, how do you think the shifts like impact on founders on how I'm thinking about spend for my go-to-market team or even like fundraising strategy, to be honest, but like especially like go-to-market, like how do you think this impacts my go-to-market spend heading into 2026?
Well, I think that every business needs to look at their own channels and see where they've experienced success in the past and continue to experiment. One of the interesting things, aside from what you highlighted here, Mike, where events is across the top, it is by far the biggest percentage across every ARR band, and it gets bigger as it goes from left to right, largely. Is to look at where you are relative to these different ARR bands because these things do shift and change over time. So you look at outbound, and outbound becomes less important as time goes on. Whereas as others may become more important as time goes on, like content marketing, for instance. So I think you need to find your own place in the journey, and this isn't necessarily a one size fits all. So I encourage people to look at this for ideas as to what may be a good channel for them and what works or what have others said works in their particular areas, and then experiment with those channels.
The paid, just looking at this now, even just like the paid media, how that ramps up towards later ARR bands, it's like counterintuitive to me. I would have thought like the other way around, where it's like I get my jump start with paid, I milk that channel for everything I can get, and then I got to go figure something else out.
Yeah, I think it's more brand building and, bigger budgets. And so people throw a lot of money at paid. And that's, partially why CAC probably increase or probably why CAC tends to increase as companies get larger. They're kind of casting a wider net, and some of that investment is not good. There's the famous quote, I'm going to mess it up here, but about how, 50% of my marketing budget works. I just don't know which 50%. I think that plays into that old adage a little bit.
Yes. At some point, we all want to sponsor the F1 or IndyCar team. That's where the that money goes. All right. I think we got one last one, which is I think also come around the idea of being in person, and that's like default in-office teams continue to grow faster than remote ones. Is this your way as an investor just to tell like companies they need to be in the same room together?
No, no, it's not. This is just really interesting data, and I think every founder, every company has to pick what's right for them. There's certainly trade-offs. You can see in the Rule of 40 that those median Rule of 40 numbers are much closer, and so there are trade-offs there when you decide to either be predominantly in person or in office versus predominantly remote. And most companies today, two-thirds of them are predominantly remote or fully remote. So. It's just an interesting data point, I think, that is a good conversation starter, and people should think about, and they need to be very intentional about how they build their culture and build their company. I mean, Mike, you guys are Visible is remote, and you built an amazing culture and an amazing team. So I think it can be done both ways. For sure, but it was interesting to see this trend across multiple different dimensions of more in-person success.
Yeah. Is there data? Do you have the data on 5 days in person, or is it just split by the 3 days or more?
We do. We asked there are four options to this question. It was either you're in office, you're hybrid, but primarily in office, you're predominantly remote, or you're fully remote. I don't remember off the top of my head
Oh
whether
yeah.
there's a difference between fully in office versus just hybrid or not. But when we kind of group them together into you're either more in office or less in office, then it was pretty clear that the in office
Yeah.
culture was growing faster.
Interesting. Yeah. All right. I promised 45 minutes. We're at 45, but we're going to stick around for just a few other questions. I'll stick on the slide here in case anyone wants to download. Let's see which questions did I not get into. Um,
One from Michael here, Mike, about how
yeah,
valuable is non-annually recurring revenue, e.g., performance-related or project-related revenue from a valuation perspective? I mean, my take is that it's not very valuable. I mean, maybe you get kind of one X credit for it, but that's a pretty simplified view. It's there's some more nuance for sure as far as what percentage of overall revenue is it, how repeatable is it, what's the margin on that revenue. But I'd say the rough rule of thumb is you can probably kind of think about it on a as roughly 1x from a
yeah.
valuation perspective.
There's a question. We can go back to the in-office slide actually. Oh, let me share my screen again.
I'll hit one other one while you're doing that, Mike,
Yep.
about, what about pre-revenue? Pre-revenue, your focus is finding product market fit. There's nothing to compare yourself to in terms of revenue growth rate. I'd say the job is find product market fit and don't run out of money. Don't overcomplicate it.
There we go. Thank you. If I had to extrapolate this from remote organizations are 8% more profitable to create the difference in rule of 40. Try to see where rule of 40 is. Median.
Yeah, I mean, I think that's
Yeah.
reasonable that, yeah, they have lower costs because one, they don't have office space that they're paying for, or not as much office space. Two, they can hire in less expensive geographies, potentially, more offshoring, or lower cost of living uh, employees. So yeah, there are a few reasons why it may be a little bit closer in terms of the Rule of 40.
Yeah. Great. Any final questions before we wrap? Let me just open up chat here. How far in advance would you recommend hitting these metrics prior to a fundraise or an exit?
Um, I my guidance there would be that if you are if you come off a really great quarter where you've hit a lot of those metrics, then strike while the iron's hot. I mean, that's a little bit of an oversimplification, but trying to just give some rule of thumb, I think that is hopefully broadly applicable to people on this call. So yeah, I'd say, think about coming off a really good quarter, a really good half a year, and using that as a springboard into a fundraising process. So I'd say is do it as soon as possible, fundraise as soon as possible after hitting those metrics.
Here we go. Well, Blake, thank you so much for your time. Thanks again for being the steward of the great data that you shared here with us today over the past few years. We're looking forward to doing it again next year. Is this like a thing where you already think about next year and we're still in the middle of the 2025 survey?
For sure. I'm already thinking about next year. I've
Yeah.
already been thinking about next year, but we were just so happy to be able to provide this data again this year to everybody, and really appreciate visible support, Customers Bank, and all those that were involved in providing data and helping us get this distributed. So hope everyone found it really valuable and helpful.
Thanks, everyone. Until next time.